Good day, Ades, Mr. Mobi, your financial accountant teacher. So, well, I'm here today uh, to share this topic with you. That's bad debt accounting. Bad debt accounting. So, but before I proceed, I would like to share this lesson objective with you. At the end of the lesson, students will be able to define bad debts, state the accounting entries for bad debt, and prepare the bad debt accounting. So we are going to look at this today. Let us look at the definition of bad debts. Bad debts. So we want to look at the definition of bad debts. Uh, Bad debts are debts which have become irrecoverable, and this is a debt that can never be recovered. So that's bad debt. And then this bad debt will appear on the debit side of profit and loss account. So to be at debit side of profit and loss account because it's an irrecoverable debt. So these are the debt that we cannot recover from our debtors. And this bad debt occurs as a result of the inability of the customer to pay his debts. So the debtor find it difficult to pay his normal debts, and this will reduce the account of debtors in the balance sheet. So when we get to the balance sheet, the debtors account will be reduced as a result of the bad debt, and this bad debt can result to death of the debtors or insolvency of the debtors. So those are the two reasons for the bad debt: death of the debtors or insolvency of the debtors. Maybe if the debtor is no more alive again or unable to pay, if debtor doesn't have money to pay. So these are the two reasons for uh, bad debts. Then let us look at the accounting entries for provision of bad debt. There are two methods which include, we have method A. That method A using bad debt account only. That means we are going to have a consolidated account, and this consolidated account is always used where there is provision, where a provision is raised or adjusted in the bad debt. Then we are going to have this account, separate account. The account will be prepared. This following account will be bad debt account, profit and loss account, as well as a balance sheet. So all these accounts will be prepared. Then before we have the question here, a business started trading on 1st January 1999. During the 2 years ended 1st January 1999 and 2000. That means these are the 2 years, 1999 and the year 2000. The following debts were written off to bad debt accounts on the date stated. So the date stated here is 5th June 1999, Shegun 200 naira. 30th October 1999, being paid 300 naira. 15th December 1999, Ayo 450 naira. 23rd May 2000, Kinde 150 naira. 31st August year 2000, Ilesami 400 naira. On 30th December 2000, Joy 160 naira. Then on 31st December 1999, the total debtors remaining were 30,000 naira. It was decided to make provision for bad debts of 1,500 naira. Then on 31st December year 2000, the total debtors remaining were 25,000 naira. It was decided to make provision for doubtful debts of 2,440 naira. So this is the question that we are going to look at this today. We are going to look at this question today, but before I proceed, let us look at the what we are required to prepare. What we are required to prepare, we are required to use method A. Our method A, we are required to use that method. We are going to use the method for method A. In method A here, we are going to prepare the bad debt account first. Let us look at how we are going to prepare the bad debt. The account for I told you that we are giving 2 years, 1999 and year 2000. So for 1999, we have Shegun 200 naira. You can see 200 naira being paid, 300 naira, Ayo 450 naira. Then we are given provision of bad debt. The provision of bad debt we are given the question is 2,450 naira. So subtract it from this from the balance of the debit side. So you are going to have 1,500 naira as provision for doubtful debt. Provision of doubtful debt. Our provision of doubtful debt is 1,500. That will give us 2,450 naira. For the year 2000, Kinde 150, Ilesami 450, then Joy 160 naira. Then the provision of bad debt that we have in the previous year, which is 1,005, will be the first to be transferred to the subsequent year. That's 1,500 naira. Then provision for bad debt for that year is 2,440. You add all this one together. Provision of bad debt will appear in the bad debt account as a result of when we are not having a separate account. But in a situation whereby we are going to prepare bad debt account separate and provision of bad debt separate, there's no need for you to transfer the provision of bad debt account in the bad debt account. So, but as a result of this, that's for method A. In method A, provision of bad debt account need to appear in bad debt account. So, and we have 3,150 naira. So we are going to subtract it from 1,500, the provision of bad debt for the previous year. So we are going to left with 1,650 naira. Then we call that balance we are going to call it profit and loss account. So for both sides, both the debit side and credit side, we have 3,150 naira for the both sides. So that is a method. Then this is another account, bad debt account. Bad debt account, you have to know that that's irrecoverable debt account. So we have bad debt of 2,450 naira for the year 1999. Then for year 2000, 1,150 naira. That's for the bad debt for the year 2000. Then we are going to the balance sheet extract. Balance sheet extract. Debtors in the question, I read the question to you the other time. That's for the year 1999. Debtors, we are given debtors as for 1999, 30,000 naira. Then provision for doubtful debt or provision for bad debt, still the same thing, 1,500 naira. So when you less 1,500 from 30,000 naira, you are going to arrive at 20,500 naira. In year 2000, the debtor given was 25,000 naira. Subtract less provision for doubtful debt, 2,440 naira. So when you subtract it, you are going to get 22,560 naira. So that is for the balance sheet for method A. So let us look at method B. Method B, for method B, let us look at method B, using separate account for bad debt. Yes, we are going to separate bad debt account from provision of bad debt account. And the entries will appear like this. A year in which provision is first made. You debit profit and loss account with the amount of provision, then you credit provision for doubtful debt, then with the provision of the amount. Then for year 2, to increase the provision, debit profit and loss account and credit provision for doubtful debt account. Then to reduce the provision, you debit provision for doubtful debt account, then you credit profit and loss account. So that is for the method. Let us look at the preparation of the account. Then bad debt account, we have for 1999, Shegun 200 naira, being paid 300 naira, Ayo 450. Add everything together to give you 950 naira. 915 naira, that means we have tried to, we've separated the provision of bad debt account from bad debt account. So therefore, year 2000, we have 150 for Kinde, Ilesami 400 naira, Joy 160 naira. Add everything together will be 710 naira. So that is then let us look at the provision for bad debt account. Provision of bad debt account for 1999, 1,500 naira. We have been given in the question. Then for year 2, we are given 2,440 naira. So you less it from 1,500 naira. So the balance will be 940 naira. Then 940 naira we are profit and loss account. Then let us look at the profit and loss account. And our profit and loss account, we have 1.5, as I've told you the other time. This 1.5. Then 915 naira. That 1.5 subtract. Why subtract 2,440 naira? There you are going to have 940 naira. So that is. Let us look at the next one. Is to look at our balance sheet extract. Our balance sheet extract. We are going to look at our balance sheet extract. Our balance sheet extract. That is the balance sheet extract. So our balance sheet extract is bad debtors for 30,000 naira, less provision of 1,005. That means you are going to leave with 20,500 naira. Then for the debtors 2,000, year 2000, we have 25,000 naira subtracted from 2,440 naira. So you are going to have 22,560 naira for the balance sheet. Then again in this topic, we also have a provision for discount. Provision for discount. It's possible that the debtors as well, someone that have been owing for years, you can give them discount as well. It's possible. So instead for you not to collect anything at all, so from your debtor, discount can provide what is called discount. You give them the rebate so that they'll be able to pay the remaining the balance. The process of discount, that's debtors. This is a charge made against profits in order to provide for an expected loss. So for the creditor not to lose the total amount of money, there's need for him to provide a provision from the amount of debtor that the debtor is owing. So this will be, it should be calculated on the net amount after deducting any provision for doubtful debt. That is for the provision for discount debtors. Then let us look at provision for discount creditors. This an addition to the profit to provide for those discounts expected to be received. So the creditor is also expecting discounts from the debtor that he wants to receive the discount from the debtors on the payment of firm's creditors. So we are also giving question here whereby we're going to look at it. This illustration here, illustration we have given profit and loss 700 naira, discount allow 1,000 naira, then transfer of discount to profit and loss account as well. Then this is how you are going to calculate this. So this is how you are going to calculate the increase in provision of that for discount. Yeah, 10% on 20,000 naira. When you calculate 10% of 20,000 naira, that will surely will give you 2,000 naira. Then the amount of debtor is 20,000 naira. Less 2,000 naira from 20,000 naira. That will remain 18,000 naira. The 10% on 18,000 naira will give you 1,800 naira. And that 1,800 naira is our new provision. Then the old provision is 800 naira. When you less it, you are going to have 1,000 naira. That means there's increase in provision. provision for bad debt must be deducted first before calculating the provision for discount. So before we calculate provision for discount, that it's necessary for us to prepare to less what is called provision for bad debt before we can say that. So let us look at the next one. This discount allowed account. Discount allowed account. We have 700 naira for debtors. Discount allowed account, that is a discount on provision for discount given on debtors. So if you discount receipt, that is a provision for discount on creditors. So we have 700 naira. Provision for discount on debtors, 800 naira and 1,800. 1,800, that is, you subtract when you minus 2,000 naira from 20,000, it remains 18,000 naira. The 10% on 10% on 80,000 naira is 1,800 naira. Then you are still going to charge 10% on that 1,800 naira. So you have 800 naira. Then you less the provision for 1,000 naira. 800 minus 1,008, that will give us 1,000 naira. So transfer this 1,000 naira to profit and loss account. So when you get to the profit and loss, this is the profit and loss account. We have discount allowed 700, provision for discount, provision for doubtful debt 1,000 naira. So then a balance sheet extract, balance sheet debtors. We are giving debtors of 20,000 naira minus 2,000 naira. I've said it the other time. That will give us 18,000 naira minus provision for doubtful debt account discount. That's 1,800. So we arrive at 16,200 naira. So my student, this is the best way you can know account, and the best textbook that you can use for you to learn more on this topic is Simplified and Amplified, Bookkeeping and Accounting by Femi Lunge. So Femi Lunge is a chartered accountant. So make use of the textbook, and as well, go to the school website. You see your lesson notes is there. Your note is there.